Good evening. My name is Jackie Knight. I'm the Corporate Trading Director for STC. Welcome to our educational webinar on real estate investing in your self-directed IRA. Before we get started, I do need to tell you a little bit about STC. We are a retirement plan administrator only. So that means we cannot provide legal, tax, or investment advice to our clients. We don't represent or sell securities or investments of any kind. We're not a registered investment advisor, nor do we represent or endorse any particular investment opportunities that might be shared in this presentation. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. In tonight's webinar, we are going to be covering some basics about self-directed retirement accounts, the benefits of self-directing, and guidelines that need to be adhered to in retirement account investing. I'm going to enumerate the services that STC offers, and then we're going to talk about choosing and funding an investment, and particularly purchasing real estate. I am going to cover some additional information on non-recourse loans and UBIT UDFI because those can relate to real estate purchases, and then I will open the floor for your questions. So first, to get started, I do want to be sure that we're all on the same page with the definition that I'm using, that we use, of a self-directed retirement plan. We are saying that a self-directed plan means that you're holding your plan with an entity, with a company that permits you to choose any type of asset that is allowed by law. So that would be anything that's permitted by the IRS, the ERISA rules. If you're working with a self-directed company and have a truly self-directed account, you should be able to own any of those types of assets. Self-direction also means that you will be managing your plan investments. So for example, if you determine that you want to own a piece of real estate in your retirement account, of course, you would decide the purchase price that you were willing to pay. You would also decide if you wanted to renovate that property and how you wanted to renovate it. If you wanted to rent it, you would decide the rental rate. So you're going to be making the decisions that relate to the investments you are holding in your retirement account. So basically, you're going to have a direct control over those assets. Now, there are quite a few different types of retirement plans. The more common ones I'll cover here: traditional IRA and Roth IRA. You've probably heard of these. They are plans that permit you to contribute each year from your earnings that year up to a certain amount. Now, both of these types of plans have the same annual contribution limits. They did go up for the 2023 calendar year. In 2023, you can contribute to both of these types of accounts $6,500 from your earnings. If you are 50 years or older, you can add $1,000 to that for a maximum of $7,500. Now, the big difference and the significant difference between these two types of accounts is the tax consequence on your contribution and subsequent tax consequences. A traditional IRA, contributions into a traditional I are pre-tax. That means you're not going to pay taxes on the money that you put into your traditional IRA, say this year. But when you begin taking qualified distributions down the road after you've reached retirement age, 59 and a half, that's defined by the IRS, and you've met the qualifications, you can take distributions from your traditional IRA and they will be included in your taxable income and taxed at that point in time. A distinct difference with a Roth is that Roth contributions are post-tax. You're going to actually pay taxes on your contribution in the year that you make those earnings and contribute that money into the account. However, when you begin taking qualified Roth distributions, they are not included in your taxable income. So in effect, what that means is you pay taxes on your contributions, but as those monies grow over time in your retirement account, then when you take distributions, the monies that were earned on your contributions really are earned tax-free as long as those are qualified distributions. Because the Roth distribution is not included in your taxable income. So a very different tax consequence for these two types of accounts. There are requirements to be met to have a Roth IRA. If you're interested in those, please let me know or talk to your tax accountant. We can give you a little bit more information. There are some income limitations, although you can do what's called a Roth conversion to a traditional, from traditional to a Roth account. So there are some different ways to make contributions into Roth IRA. Now, an additional plan is a SEP. This is a simplified employee pension plan. And this is used sometimes by sole proprietors, people who work for themselves might have a SEP. It does permit both an employer and an employee contribution. You can be either a sole proprietor and fill out a Schedule C with your taxes, or you can be giving yourself a W-2 from the business. But it does permit you to make contributions from the business that your SEP plan is on. And for 2023, that amount has also gone up to a maximum contribution from the earnings of the business to $66,000. So certainly a larger contribution than you can make from earnings to a traditional or a Roth IRA. Another plan is a savings incentive match plan. I've seen this used, again, some sole proprietors, some partnerships. For the nuances of these plans, you will want to talk to your tax accountant. Maximum contribution in 2023 for a simple also went up. It's $15,500 this year. And now I've brought out onto your screen plans that say former employer. 401k is basically a for-profit corporate type of plan. If you worked for a corporation, you might have participated in a 401k. 403bs, often used by nonprofits or charitable organizations. TSAs, tax-sheltered annuities, TSP, thrift savings plan. If you formerly worked for an employer and participated in one of these types of plans, and you no longer work there, then you can move the monies out of that plan into a plan that you qualify for, say a traditional IRA, and then you could choose to self-direct those monies if you wished, working with a self-directed administrator. If you are currently employed and participating in one of these types of plans, then you will need to go to your plan administrator and get information about if you are eligible and able to move money out of the plan into a plan that you qualify in order to self-direct. So you will need to go to your plan administrator if you're currently employed. One last additional type of plan I'll just mention is a solo or uni, some people call it 401k. And this is a 401k that a sole proprietor might use. It does have some nice advantages if you are a sole proprietor. And by sole proprietor, I mean basically you are in business for yourself, by yourself. A spouse could also be part of the business, but basically no, very, very limited employees, basically no employees but yourself. Solo 401k has some nice features for a small business owner. You can make both employer and employee contributions from the earnings of the business. You can also set up a Roth provision in the loan documents so that you can make Roth contributions into your solo 401k. And the plan can also be set up so that it has a loan provision. And that loan provision is interesting because the loan does not have to be for business purposes. It can be for any purposes as long as it is paid back to the plan according to the terms with the interest and in the time that's required. So it does have some benefits to small businesses. One thing to know about a solo 401k plan, if you are interested in that, you do need to have the plan set up by year end of the calendar year you want to make contributions for. So it's already too late for 2022 because December 31st is past. But if you are interested in the solo 401k for 2023, you just want to make sure you have that plan set up by December 31st, and then you can fund that plan with 2023 earnings. So those are just some types of retirement plans. And of course, if you are working with a self-directed administrator, then you can self-direct the funds in those plans. I do want to talk briefly about the benefits of self-direction because some individuals may not understand why they would want to do this. And probably one of the biggest reasons is that you can truly diversify the asset types you hold in your retirement plan. You're not limited to stocks and bonds and mutual funds. You can invest in real estate. You can purchase mortgages and notes. You can make loans. You can own parts of a private business. You can own a private business. There are some, of course, rules that will need to be followed, but you can really diversify into different types of assets. Again, you're going to choose and you're going to control the decisions related to the particular investments and the transactions that you engage in a self-directed plan. When you're looking at real estate, you can also increase your buying power by using leverage. In other words, your retirement plan gets a loan in order to purchase a piece of realty for your plan. We're going to talk a little bit more about that and some nuances related to that, but that does give you the opportunity to use other people's money to fund an investment that your retirement plan can earn on. And because of all of these things, you may be able to experience a higher return on some of your retirement investments. Now, retirement plans are given tax preferential treatment. They're not taxed in the current year. They're taxed when you take distributions, with some few exceptions. So there are definite guidelines that the IRS has set up related to retirement plans and things that must be followed. First of all, there are administrative requirements, and these guidelines relate to self-directed or non-self-directed retirement plans. These requirements are for all retirement plans. Every year, an annual valuation of your account must be made, and an annual report must be submitted to the IRS. It's a Form 5498. Detailed books and records of all of the transactions in your retirement account must be maintained. In some cases, depending on what you own and where you own it, state filings might be required. And in some rare instances, a tax return might be required by your retirement plan. I'll talk a little bit more about that. It's pretty rare, but it can happen. Now, STC is a full-service, self-directed retirement plan administrator. So we will take care of these administrative requirements for you. With one exception, we cannot complete the tax return, but we can give you, your tax accountant, all the necessary documentation so that that can be completed if that becomes a requirement. Now, in addition to those administrative guidelines, there are some things that you can and cannot do with the investment. For example, there are some prohibited assets, things that your retirement plan may not own by law, by the written rules. And one is life insurance contracts. Now, there is an exception to this rule, and that is if your plan is a solo 401k plan, then you can have a life insurance contract as an investment in the retirement plan. Any other plan, that is a no, you cannot. In addition, some other prohibited assets are collectibles, and these would be things like rugs, works of art, stamp collections, coin collections. Now you'll notice I'm saying coin collections. You can own precious metal in a retirement plan, and there are certain defined types of precious metal, but it can't be, and certain types of coins, but it can't be a coin collection, like a rare coin collection. So if you are interested in precious metal investing, we are seeing some people a little bit interested in that right now. Then I'll be happy to give you some information on what STC can hold for you. In addition to those types of prohibited assets, there are transactions that are prohibited. Now, your retirement plan is given tax preferential treatment because its purpose is to benefit you when you reach retirement age. So when you are engaging in transactions in your retirement account, they do need to be transactions that are for the exclusive benefit of the plan, not to benefit someone else or you personally. You cannot personally borrow money from your retirement plan. You also cannot pledge your retirement plan assets to secure a personal loan, cannot be collateral for a personal loan. You also cannot utilize your personal credit or guarantee to obtain a loan for the plan. So you'll remember I said that your retirement plan can get a loan to purchase realty, but you cannot personally guarantee that loan. It is going to have to be a certain type of loan, a non-recourse loan. We'll talk a little bit more about exactly what that means, because you cannot personally guarantee a loan for your retirement plan. You also cannot benefit any disqualified person with a transaction that your retirement plan engages in. So let's take a look and see who these disqualified persons are. And you'll see that the first person is you. You and your retirement plan are distinct entities. Your retirement plan cannot do a direct transaction with you. So let me give you an example. Let's say you own a vacation rental condo in Myrtle Beach. Your retirement plan cannot purchase it from you. That would violate this disqualified person rule. And I will also say that if you are married, this includes your spouse. If your spouse owns that vacation condo, your retirement plan cannot purchase it from your spouse. There are other family members who are also disqualified. Ascendants, so that's parents, grandparents, great-grandparents on up the line, and your descendants, children, grandchildren, great-grandchildren, all the way down the line, are also disqualified. So if your mother owns that condo, your retirement plan cannot purchase it from her. If your son owns it, your retirement plan cannot purchase it from him. However, lateral family members are not disqualified persons. So that would mean people like your brothers and your sisters, they're lateral family members, your aunts and your uncles, your cousins, your nieces, your nephews. All of those are not disqualified persons. So if your sister owns that property, your retirement plan could purchase it from her. So just some nuances of these rules to help you kind of think through how you might want to transact in your retirement account. There are also two entities that are disqualified persons to your retirement account. Any company, if you're a majority shareholder, doesn't matter how the company is organized, S Corp, LLC, doesn't matter. If you're a majority shareholder, it's a disqualified person to your retirement account. Also, any company, if you're an officer, a director, or a highly compensated employee. So often I will be talking to individuals who are real estate investors who are interested in owning real estate in their retirement account. And they might be operating their real estate investing business through an S Corp, for example. That S Corp, if they are a majority shareholder or an officer, director, highly compensated employee, then that corporation, S Corp, whatever it is a disqualified person to their retirement account. So their retirement account couldn't purchase a property from that real estate investing business. So just some things to keep in mind. I will mention that we do not expect our clients to be experts in all of these rules. This is just for your general information. Part of our job is to help you know what is an allowable transaction and what is not. So our full service approach is we actually set up an LLC structure for your retirement account that becomes your investing vehicle. We have CPAs and attorneys available to answer all technical questions about all the nuances of retirement account investing. We have a wonderful client services department that can give you unlimited guidance on transaction compliance. We will handle all of that back office administrative support that I mentioned. We will maintain LLC financial statements for your retirement account, so you will be able to see in detail all the transactions and you'll have financial statements. We will supervise that regulatory reporting that is required, and we will oversee the annual valuation that is required. So our approach is that we will handle all of the back office support, paperwork, administration that your account needs. We will give you guidance on all the guidance you need on transaction compliance, helping you understand the nuances of the rules, looking at your transaction, giving you guidance on its permissibility according to the law. So we will do all of that for you. And that way you can focus your attention on finding the best investments for your retirement account. That's really what you get to do in the self-direction retirement account. Now, I do want to just enumerate on the LLC structure that we use for each of our clients' accounts and why we do that. It does have a number of benefits for our clients. One of them is it gives you a great deal of flexibility in structuring transactions. We have some clients come to us with very complex transactions. They might have multiple parties to the transaction. There might be several owners, co-owners of the investment, the retirement account being one of them. There might be a loan involved. There might be a rehab project involved. So many different types of transactions and nuances to those can come up in this type of a scenario. So using an LLC structure can give our clients a great deal of flexibility in structuring those transactions and making them work within the rules of the IRS. Having the LLC structure it is a limited liability company. It's a very specialized one, but it is an LLC, so it does provide an additional layer of asset protection. And it gives you checkbook control over your retirement account funds. So that means you have immediate response to an investment opportunity. We know that good investments can come and go very quickly, so you need to be able to move on them. So you'll notice that I have checkbook control in quotes, and that is because we don't actually give our clients the checkbook for their retirement account. There are companies that do that. We prefer not to, just in the event that you might unknowingly engage in a prohibited transaction by writing a check. And the penalties for doing that can be very severe for engaging in a prohibited transaction, violating some of those rules I just went through, up to even forfeiting your retirement account and it suddenly becoming all taxable to you, distributed and taxable to you. So what we do instead is our client services department reviews your transaction and then can same day or next business day fund it for you. So that way you have our experts looking over all the details of your transaction to make sure that it complies, and then we can immediately issue the funds if it does. So basically you kind of have a checkbook, but you have protection in that our experts are reviewing your transaction. So that's very important if you don't know all of the rules and regulations that relate to retirement account investing. Now, this does also simplify asset titling, especially in a real estate purchase. You can go to the closing on behalf of your retirement account and sign the closing documents on behalf of your retirement account because you will be the investment manager of this LLC. So it does simplify asset titling for purchase and for sale. And it also makes it easy to pool or partner with other funding sources to co-own an asset, which I'm going to talk about a little bit more too. So your retirement account does not have to solely fund an investment. Sometimes real estate investments can be very good in syndications, and you might be one of many investors in a real estate investment. So using an LLC structure can also facilitate that as well. Now, just again to mention, this is not a generic business LLC. It is a very specialized LLC. Its operating agreement and its articles of incorporation are written specifically for it to be owned by a retirement account. So it is a very specialized LLC that our office sets up for you. Okay, now let's talk about choosing investments. because you're getting into a self-directed account because you want some flexibility in choosing maybe from a wide array of investments. So the first group I'm going to bring out are all different types of real estate investments. Here you see single multifamily homes, vacation property. With one caveat, let me just mention that if your retirement account does purchase vacation property, you personally and your family cannot vacation in it. It is truly an investment vacation property, but you can do that for sure. You can invest in something that you're going to rent out at the beach. Raw land, building lots are acceptable. Commercial buildings. So this might be a commercial building. You might not be able to fully fund that with your retirement account, but if you pool or partner with other investors and have a group investment, you might be able to own a commercial building. Real estate syndications, tax liens. Now, tax liens aren't exactly purchasing realty, but they are purchasing the right to collect real estate taxes. And I do cover that in another webinar, so I won't elaborate on that. But that, if the lien is not repaid, you can foreclose, and then you would own the real estate that the lien was on. But those are real estate types of transactions. You can also invest in mortgages, loans. You can make loans from your retirement account, private business investments, operating businesses, precious metals I mentioned. You can also invest in the Forex market, foreign currency, options, futures, and of course, you could have stocks, bonds, and mutual funds. And you can actually have that in your self-directed account as well. Now, I will make just a note here because I am going to get into specifically real estate, and because I do often have real estate investors in the audience. Many times real estate investors will purchase a property, rehab it, sell it, buy another one, fix it up, sell it. And you certainly can do that. One thing you need to be aware of is if you do that many times in a single year, then that can be looked at as a business within your retirement plan. And in that case, if it is looked at like a business by the IRS, then that would trigger a tax. So if you are interested in doing multiple transactions of that type in a year, we tend to take the conservative view that doing 2 or 3 of those in a year doesn't make it an investment, doesn't make it a business. Again, you can check with your tax advisors to see how they advise you, and you can make that decision. But that is something to consider if you are interested in doing that type of investing in your retirement account. Now let's talk just briefly about how you would invest your funds as a client of STC. So it's actually very, very straightforward. Basically, you're going to find the investment. That's your job. You find what you want to invest in. And then step 1 is optional, but I highly recommend it, and that is to request a review of the transaction and its structure in advance of actually closing on it, in advance of sending the money to the seller. And you can do this as much as necessary. That's a major function of our client services department. So they will review your transaction. Then what actually starts the process is you will complete a request to transfer funds. It's a document that is one of our forms, and you'll put the backup to your transaction with that, and you will send that to our client services department, and they will review that transaction. Once they've reviewed it and determined that it is permissible within the rules of the IRS, then they'll process that transfer request, and the money will go from the LLC bank account that your LLC has access to the seller, and then your retirement account will own that asset. So it's a very straightforward process. And this can be a 24-hour turnaround time. Once we review the transaction, if there's any question about it, of course, client services will get in touch with you right away. But assuming that you've had it reviewed in advance and it's all good to go, and now you're sending the final documents, we should be able to same day fund that transaction, or if we receive the documents after the bank cutoff, then next business day. So very quick turnaround to process your transaction. Now, let's talk specifically about real estate. It's probably what most of you wanted to hear about tonight. So the first thing is you are in charge of your self-directed retirement account, so it will be your job to locate the property that you want to purchase in your retirement account and to make an offer. Now, it's very important that that offer is in the name of the buyer, in this case, your retirement account. So the offer does need to be made in the name of your IRA LLC, and you're going to select that when you open the account with us. You're going to choose a name, and that will be the name that you will put on the offer. Now, often times you'll be required to do an escrow deposit, and what we would need to do that is a copy of the contract that shows the IRA LLC as the buyer. It's got the correct name on it, and also a request, our form, with the dollar amount of that escrow so that we can prepare that for you. We do ask that you give us the documents at least one business day before closing. So that would be the HUD documents or settlement statement showing the IRA LLC as buyer and a request to transfer funds. Because if we do see any difficulties with it, like you are buying something from your father, which wouldn't be allowed, then that can hold up this whole process or eliminate the process. So it's always better to give more advance notice if possible, just in case there's an issue. Okay, now, and so if there is an issue, we would discuss that with you. Now, you will likely need guaranteed funds for closing. So that's usually going to be a wire transfer. In fact, I think that these days it's pretty much official. I suppose it could be a bank official check. I haven't done one of these transactions recently myself, but we will get whatever you need based on that form that you've given us. Then you will go to the closing and you will sign all the closing documents, and then you will send us a copy of the closing documents, and you can keep the originals, but then now that asset will be held in your retirement account. Now, again, we are going to talk about borrowed funds. You can use borrowed funds. It must be a non-recourse loan. And I am going to define that for you fully in a moment. But it must be a non-recourse loan. And again, if you do use borrowed funds, it could trigger UDFI, Unrelated Debt Financed Income, which is a subset of UBIT, Unrelated Business Income Tax. So we'll talk about that also. So back to purchasing the real estate. Now, you can partner with anyone at the inception of your real estate transaction, and that includes people who are otherwise disqualified, like your spouse, like your father, like your daughter. As long as you do this partnership or this purchasing, co-purchasing at the inception of the transaction, it is permissible. Now, the ownership percentage in this transaction can never change. Let me throw out an example here. Let's say that you are purchasing a house. You, your father, your daughter. Your retirement account is putting in 50%, your father's putting in 25%, your daughter's putting in 25%. So those percentages must be maintained throughout the entire transaction. So that means, for example, if you need to put a new roof on this property, your retirement account would pay 50% of the cost of that roof. Your father would pay 25%, and your daughter would pay 25%. That keeps the ownership percentage equal. All expenses are paid pro rata based on ownership, and all property revenues are distributed pro rata. So now if this is a rental property and it earns $10,000 a year, something like that, then your retirement account is going to get 50% of that $10,000. Your father's going to get 25%. Your daughter's going to get 25%. Those percentages always have to stay the same when you have disqualified persons partnering in a transaction. But it can be done, and it is permissible as long as the rules are followed. Now, we do have some real estate investors who like to set up an LLC for a particular property. And you can do that. You can set up a sub-LLC within your retirement account investing LLC that will hold a property. But you just have to keep in mind that all the same rules apply. Nothing changes. You still can't partner with anybody who's disqualified. You have to follow all the rules. And what we would need to see is we would need to see the documents of that setting up that sub-LLC, and we would want to see, the operating agreement stating, who owns this LLC, how much are they contributing, what's their percentage of ownership. Again, we're going to expect those percentages to match up with the amounts that they are invested. So it is possible. It does require some extra work on your part if you want to do that. And our client services department will walk you through what that would mean for you. But it is possible to do that. We know that some investors like to do that. In all of these purchases, again, you have to remember that the rules have to be followed, IRS rules. Disqualified persons cannot do any rehab or repairs. So that would mean you can't go out there and fix the refrigerator. Your spouse can't. Your son can't. Now your brother can because he's not disqualified. So no rehab or repairs by a disqualified person. Also, disqualified person cannot be a tenant. So again, your son, daughter can't be a tenant. Your sister could be. Your brother could be. And cannot be a buyer or a seller of that property. Now, again, we will help you walk through these things to make sure that you're not engaging in a disqualified transaction, but you kind of want to keep these things in mind as you're thinking through transactions you might want to engage in. Now, I said earlier that you can partner with others to co-own an asset. So let me just give you an idea. Here is self, spouse, and family members. I told you they were disqualified persons. However, again, if you partner with them at the inception of the purchase transaction, you can partner with your own personal money or with your spouse's retirement account or with your father or your daughter. But you will want to run this transaction by our client services department, and we want to make sure that everything is happening at the appropriate time and titled properly. You can also partner with investing colleagues. LLCs can be companies, and investment syndications. So many opportunities for you to co-own your retirement account, to co-own an investment. So here's just a little schematic of our retirement plan structure. Your current custodian is on the upper left. You decide you want to open an account with STC, so you complete documents that direct your current custodian to transfer or roll over your funds to our self-directed custodian. We are setting up an LLC, that green block in the middle, in the state of your choice, that is going to become your investing vehicle. Once the money has reached our custodian and the retirement plan LLC is set up, then ownership of that LLC moves to the custodian and the funds move to a bank account that your LLC has access to. Then you're ready to invest. In this scenario, investment number 1 and 2 are wholly owned by your retirement account. Number 1 is a tax lien investment, and number 2, you purchased a property for rehab and rental. Now, number 3 is particularly interesting because it has 4 co-owners. Your retirement account is one of them. You actually pooled money from your retirement account with your father, your daughter, and some of your personal money to purchase a small retail center. And this works even though those three people are otherwise disqualified persons, as long as you co-invest at the inception of the purchase transaction, and those ownership percentages are always maintained the same. They never change. So if you need help understanding that, we can also help you as a client. We'd be happy to help you understand how that can work. Now, let me go into some detail on non-recourse loans. First, what is a non-recourse loan? I told you that you couldn't use a personally guaranteed loan to buy a piece of real estate, but you can use a non-recourse loan with your retirement account. And this simply means that the security instruments, the notes, the mortgage, allow the lender no recourse against you, the individual account holder, or any of the monies in your retirement account. The lender only has recourse to the property itself. That's the only source of repayment of the loan. That's why it's non-recourse. So it's your retirement account that's getting the loan. Your retirement account doesn't have a job. There's no income or employment verification. It is more like a commercial loan. Some of the industry standards, of course, you will need to go and, if you're interested in getting a non-recourse loan, talk to specific non-recourse lenders. It's become much more common as more and more people are discovering self-direction. Required documentation, of course, a loan application, purchase and sale contract. They're going to want to see your IRA statement or whatever your retirement account is. You're going to want to see that. They'll want an appraisal of the property, probably want a rent roll if it's a rental property. Loan guidelines, maximum loan to value is probably going to be 70%. So you will definitely be putting down a larger deposit than you would a personally guaranteed loan. Maximum term, 20 to 30 years. We have seen non-recourse loans, adjustable rate mortgages, 3-1, 5-1, 7-1, so lots of different terms you might get. They're also probably going to be looking for an income to expense ratio on that property of 1.25 or higher. And they are going to likely require you to hold 3 to 6 months of expenses in reserve in your retirement account. Now, let me just explain why that is. If your retirement account owns this property, then any expenses that come up related to this property must be paid by your retirement account, not by you personally. So you need to have sufficient funds to, say, pay real estate taxes, or maybe have a little bit of a reserve if it's an older house, an older property, for some repairs. Unless you are eligible to make a contribution for that year into the account, the money is going to have to be there. So a lender is likely going to ask you to have some dollar amount of reserves available in your retirement account. Eligible properties, single-family residences, some condos, you need to check with your lender. 2 to 4 plexes, multifamily, small apartment buildings, big apartment buildings, retail, office, warehouse, all eligible. Things that are not eligible, mobile homes, timeshares, and condo hotels. Those have kind of become a thing recently. Some restaurants, residences with 5 or more acres, and farms are generally ineligible. So that's a little bit about non-recourse loans and how they can be used to fund a real estate transaction in your retirement account. Now, if you use a non-recourse loan, then unrelated business income tax in the form of UDFI, unrelated debt financed income, will come into play. The IRS has determined that using debt financing has enabled you to make money that you otherwise couldn't, and so it's going to be taxed. So this is I'll go through the tax, and then we'll have a little walkthrough to help you understand it. UDFI is based on the net income of the property. So that means you get to deduct all of the expenses. It applies to income that's generated from an asset that was purchased using financing. So, for example, let's say this piece of real estate, you turn it into a rental property. So now you're earning rental income on a debt-financed property in your retirement account. UDFI is going to apply to that income, that rental income that your retirement account is getting. Now, it's based on the net income, so you get to deduct all of the expenses related to that property. The first $1,000 of net income is exempt from the tax. And then the percentage of taxable income is based on the ratio of debt on the property. So, for example, let's say the property, just to use round numbers, costs $200,000 and you debt finance $100,000. So you put in $100,000 from your retirement account, you got a loan for $100,000. That means that property is 50% debt financed. That means that only 50% of that net income is taxable, is UDFI taxable. So when the asset is sold, then a percentage of the gain may also be subject to UDFI if that loan was still outstanding or had been outstanding for the last 12 months. So that's a little more detail than you need, but let me give you an example investment, because I have talked to folks who say, "No, I don't want to do it if I'm going to have to pay taxes from my retirement account." But you might want to consider doing an evaluation, because maybe the income that you would earn if you could afford to buy the property using leverage might outweigh the tax consequence. So here we're going to assume that you have a rental property that's 50% debt financed, just to make this easy to calculate, and the annual net rental income is $12,000. So I say net, so that means we've already deducted all of the expenses. So $12,000. Now, I said that the property is 50% debt financed. So the dollar amount that's actually subject to the tax is $5,000. That's $12,000 times 50%, which is $6,000. And then I said the first $1,000 is exempt from the tax. So that takes us down to $5,000. So $5,000 is subject to UDFI. Now, I just looked up the 2023 trust tax rate today. It actually, it's a graduated tax, and the levels have gone up a little bit. So it's a little less than it would have been. For this example, the taxes in 2023 would be $794 on that $5,000. So your net income after UDFI is $11,206. So by doing this calculation, you can see, okay, is it worth it to earn the $11,206 and have to pay $794 in taxes, or am I just going to forego this investment completely and try to do something else? So that's an analysis that you might want to do. Now, unrealized, the tax is reportable to the IRS on Form 990-T. Again, taxable at the trust tax rate. Please do discuss it with your tax advisor. It is, I will also say that the tax must be paid from your retirement account. You can't pay it personally. Your retirement account owes the tax. But of course, you got that $12,000 in the account, so you can pay the taxes from the money that is in your account. Okay, so on that note, that was a lot of information. Perhaps it generated some questions. Please type them in the question box if you haven't already. While I open that up and look for some questions, please notice I put our contact information on the screen. We have a great deal of information at stcira.com. Our corporate office number is there for you, and you can certainly get in touch with me. I welcome any questions that might come to you afterward at jknight@stcira.com. Okay, let me open up my box and see if I have any questions. And feel free to type in as I'm going through this as well. Okay, so this was typed in earlier. Can I get a mortgage on a property for my IRA? Yes, you can. It must be a non-recourse loan. Again, it's more like a commercial loan, and you can just review those guidelines I gave you for that. Okay, this is actually a question about RMDs, required minimum distribution. Once you reach a certain age, and that has changed recently with some recent congressional acts, I believe it's 73 now, but again, check with your tax accountant, you're required to take minimum distributions from some accounts, like a traditional IRA. And this question is asked, and it is a calculation that's done based on a formula that is published by the IRS. This question says, is the RMD based on total assets or cash in hand or equity? Generally, I'll state this and then direct you to your accountant. Generally, the RMD is calculated for each account that you hold by looking at the December 31st balance of that plan and then dividing it by a life expectancy factor that they've published each year. So if you own real estate, the fair market value of that property is going to be included, but if you have an outstanding loan, that would be deducted. So it would be the equity in the property, but after a new appraisal is done. If you do have more than one account, and a lot of people do, then that RMD is calculated on the combined balances of the accounts, but you can take the monetary distribution from a single account. You don't have to take it, in pro rata or share from each of your accounts. The amount's going to be calculated based on all of them, but the distribution can come from a single one, or it can come from different ones. Okay. Okay, I own several traditional IRA accounts and have money in a former employer's 401k. Can I roll over part of the money into a new self-directed account and then later in the year roll over additional money? Okay, this term rollover can be misunderstood, so I'm just going to define something. A 60-day rollover can only be done one time per year for all of your accounts in aggregate. But let me define what a 60-day rollover is. A 60-day rollover is when you request a distribution from your custodian and they send you the money. The check is made out to you. You have 60 days to get it back into another retirement account that you qualify for without there being tax consequences of a distribution. That's a 60-day rollover. Now, if we're talking about moving money from one custodian to a new custodian, there are no limits on that. You can do that as much as you want to. So you could move, let's say you liquidate stocks or bonds or whatever in one of your accounts, and you want to move $25,000 to an account with us. Then it would go from your custodian, that cash, to our custodian. And then a month later, you want to liquidate some more and move another $50,000. So you can do that. There's no limitation on transferring money custodian to custodian. Can you give me some ideas for possible investments for smaller accounts? Sure, like tax liens, that's a nice one. I do have a webinar recording with someone who has done a lot of tax lien investments that might be of interest to you, and that can help you see some states offer very high interest rates for tax liens, but you do need to understand how they operate and what their purchase process is and that kind of thing. So tax liens are a possibility. Private notes, private lending. I have spoken at many real estate investor associations, and they are always looking for money. So they often they are potential sources of, investments. You can lend money to a rehabber, for example. I would suggest that if you do that, you get the property, you put a lien on that property so that if they don't pay you back, you can foreclose on that. But that's making a loan. I know at least one of our clients does do private lending to somebody for a guaranteed rate of 10% return. So And then back to that partnering with others. That's a big way, or partnering with personal cash. Okay, let me open. Okay, now someone has sent in a question. My LLC owns a glamping site. Can my self-directed IRA purchase a dome, additional unit for renting out? When you say my LLC, I'm assuming you're talking about one that you personally, your personal LLC. And if that's the case, then the answer is no, because that would be doing a transaction with yourself, basically, a company that you own. If I'm misunderstanding the question, please give me some more clarification. And another one, I just left my old employer, had a 403B plan. I can transfer all of my money to this self-directed fund. You can, yes, you should be able to, unless they have some unusual requirement. If you don't work for them anymore, you shouldn't need to participate. And I worked with a company and administered their 403B plan. And when an employee left, they could leave the money, but they had the option to take it all out. So I would imagine that yours is similarly structured. And now you do say in this, you're saying I can, but I think you mean, can I transfer all of my money to this self-directed fund? First, let me say that it's not a fund. It's a self-directed retirement account. So you would be liquidating your assets. I'm not sure what type of assets you have with your old employer plan, but you would be liquidating them and then directing the plan administrator to move those liquid funds from your custodian to our custodian. You would complete some documents in order to direct that. Then your money would move into a self-directed account with us. That money would reside in a bank account, and now you are ready to start investing that money in assets that you choose. So that should be a possibility. If you want to discuss that more, you want to look at paperwork, please get in touch with me. Oh, my time is just about up. Let me just see if I can. I had a couple come in advance. Can I use my IRA funds to make an investment with my spouse? Okay, so this was asked prior. So typically, again, no, because your spouse is a disqualified person. However, if that transaction is structured properly and you co-invest, so it's not something that your spouse already owned or you already owned that your spouse would be purchasing, but it's something that neither of you had participated in, and you're purchasing it from a non-disqualified person. As long as you co-invest at the inception of the transaction, we can help you with that type of a transaction. So yes, that is a possibility in that case. If you do decide you want to do that, I ask you, please get in touch with our client services department early on so that we can help you understand how to have the documents written, titled, so that, and where the money is coming from, so that it will all be structured properly. Well, folks, thank you so much for joining me. I'm sorry I've run out of time. If questions come to your mind after I close off, please do give us a call or send me an email, and I'll be happy to help you. We hope that we can serve you in the future. Thanks for joining me tonight. Good night.